Here, today we're taking a very close look at this market advance. So as we know by now, on Monday, November 20th, the S&P 500 14-day RSI hit overbought territory for the first time since the beginning of this run. And so we can continue to compare this advance to the one that we saw from March through July. And back then, the first time that the indicator hit overbought territory was on June 12th. And this is interesting because it came 3 months after the low. And more importantly, we did not see the market peak until about 5 or 6 weeks later, right at the end of July there. So 5 or 6 weeks after right now would take us all the way till the end of the year, which of course would mean that the S&P was going to continue this run and take advantage of positive seasonality. But we know that all time frames are not the same. And so a very interesting perspective is this. It took 16 trading days to go from oversold on October 27th to overbought on November 20th. And if you go back again to when we saw the overbought condition in June and go all the way back, the last time we had an oversold reading wasn't in March, even though it got close with the RSI reading of 34. It was back on September 29th, 2022. So as we can see here, we went 255 trading days between oversold and overbought levels. So nearly 3/4 of price action, even though the market was up considerably over that time frame. And as we talked about in real time as it was occurring, this was not a straight shot higher, right? There's a lot of jagged back and forth with 8% decline, 9% decline, and then finally things took off in a more consistent manner. And so what we have here is that this time frame was 16 times longer than what we just had. So it just tells us again how severe of a move this has been in quite a short period of time. And so the question is, of course, are we getting to the other end of this pendulum? If these are different indicators that we look at, just some of them at CappThesis every day, and needless to say, each one of them have flipped from oversold to overbought. At the time on October 27th, we had a 3-day losing streak, but that came after a 5-day losing streak. And then the market was also down 10 out of 12 days at one point. 2-hour RSI was oversold, 14-day RSI was oversold. Now both are overbought. We're below each of the key moving averages. Now we're above each of the key moving averages. And the only one that was slipping higher at the time was a 200-day moving average, right? And then at the low, of course, no bullish patterns. Now we have 2 that are live after yesterday's action. 2 bearish patterns were live, and of course, not one bearish pattern is in play right now. And a key part here is that the CNN Fear and Greed Index hit extreme fear back on after the action on the 27th for the only time that it happened during that entire run. And then, of course, with the market then rallying starting the next week, it quickly flipped back from that point. And over the last 2 days, we finally exited neutral into the greed area. Now, not extreme greed yet. That's important to realize because the CNN Fear and Greed Index, as you may know, looks at 7 different factors. One of them being the new 52-week highs versus lows on the New York Stock Exchange, which still is in the neutral section. That's important to consider because the S&P 500, of course, isn't a new high right now either, as are many of its holdings continue to be below their recent highs as well. That's not surprising. That's typically a lagging indicator on a market comeback, especially off of a high that was in the past here. And so as things continue higher, this may hit it again. And so the last time that the S&P 500 made a new 52-week high was on June 2nd as the market was coming back. That did not mark a high, as we know. Market continued almost 2 months later. So all of this suggests that probably could stand at least some more digestive activity, kind of what we saw last week, to try to get some of these very stretched short-term indicators back to normal. And then from there, possibly make another up leg. And the question is, how likely is that? Well, let's look at this from a zoomed out point of view. This is a weekly chart looking at 3-week rate of change. And through last week, S&P was up 9.6%, which is a lot because as we have here, only 6 prior times since the financial crisis did we see a 3-week move of at least 9.5%. Needless to say, 5 out of those 6 times, the market continued higher for months and years to come, right? Happened right around the COVID lows twice. We saw right after the volatility low of 2011. That gave way to this, of course. And then also occurred right at the low, right after the low from March 2009, later that summer as well. The only red line here signifies what happened in December 2008, where, of course, we had further to go. But big picture, it did happen more toward the end of the massive collapse as opposed to the beginning of it, right? So let's take this into account. It's just an other study that suggests that when you have a lot of strong action after a kilo, after a volatile period, it does tend to lead to better uptrending markets, right? That this kickstarts areas that were once going lower and then can lead to positive momentum in a more consistent manner. So those are the things we'll be looking for, of course, going forward. Don't forget to check out these videos and subscribe, and I'll talk to you next time. Thank you.